Good morning, I am Malik. Welcome to the War Room. Today is Thursday, February 26th. If you are looking at your screens trying to guess the bottom, stop. What we witnessed yesterday was not a panic sell-off, it was a structural freeze. On Wednesday, the KSE-100 Index bled out another 1,600 points. We sliced straight through the safety nets and closed at a battered 164,600. Volume remained brutally high, with nearly 620 million shares dumped onto the main board. Retail traders are screaming about the IMF. They are terrified of a super tax. But retail is wrong. The tax rumors are just the smokescreen. If you want to know why the market is crashing, you have to follow the actual flow of capital. You have to understand the mechanics of the liquidity vacuum. Let us talk about the real reason the smart money is liquidating. While everyone was distracted by the Federal Board of Revenue, the government quietly finalized a massive financing agreement. They are pulling together 1.2 trillion rupees from a consortium of 18 commercial banks to plug the energy sector's circular debt. Ask yourself, where do 18 commercial banks suddenly find 1.2 trillion rupees in a high-interest environment? They drain it from the equity markets. They are stripping cash out of the stock exchange to fund this sovereign bailout. The state bank's policy rate is down to 10.5%, which should be aggressively bullish for stocks. But it doesn't matter if the cost of capital is cheap when the supply of capital has been entirely vacuumed up by the government. This is why blue-chip giants like Mizzen Bank, United Bank, and Hub Power are bleeding out. There are simply no institutional buyers left in the room. The banks are hoarding cash. Until that 1.2 trillion rupee transaction clears, the stock market is running on empty. Now, let us look at the global board. Everyone is watching Brent crude prices fluctuate due to the US-Iran standoff. But oil is the wrong metric. The real killer is sitting in the Strait of Hormuz. Foreign portfolio investors aren't just reacting to the threat of war. They are reacting to the collapse of the global supply chain. War risk insurance premiums for vessels in the Middle East have jumped by 60%. Freight charter rates for supertankers and container ships have spiked by over 118% in the last 3 weeks alone. This is an invisible tax on the global economy. For Pakistan, this is devastating. Our export sectors, specifically textiles and manufacturing, are about to see their profit margins completely wiped out by these exorbitant shipping costs. You cannot remain competitive globally when it costs twice as much just to put a container on a ship. This brings us to today's battlefield, Thursday, February 26th. We have a slate of board meetings that will directly test these two macro theories. 11:45 a.m., Nishat Tunian Power, NCPL. This is an independent power producer. With the government pulling 1.2 trillion to clear circular debt, the IPPs are first in line to get paid. We need to see if NCPL announces a monster dividend. If they hold the cash back, the market will panic. 1 p.m., Engro Holdings. This is the undisputed heavyweight fight of the day. Engro closed yesterday near 258 rupees. Their fertilizer and energy divisions are completely exposed to both the circular debt crisis and global supply chain shocks. Engro's forward guidance at 1 p.m. will dictate the momentum for the entire holding sector. 2 p.m., Gul Ahmed Textile, the textile titan. Remember the invisible tax on shipping we just talked about? We are going to look directly at Gul Ahmed's margins this afternoon. If they report massive freight cost damage, the entire textile board will gap down. Here is your battle plan for Thursday. 1. Respect the vacuum. Do not try to catch falling knives. The institutions do not have the liquidity to support a rally right now. The floor is 163,000, but in a liquidity vacuum, floors are made of glass. 2. The Engro anger. Keep your cash entirely holstered this morning. Do not make a single move until the Engro numbers drop at 1 p.m. Let the algorithms and the institutions digest the payout first. 3. Park the cash. If you liquidated your positions earlier this week, move that capital into high-yield money market funds. Let the banks pay you while they fund the government's debt. I am Malik. We do not trade on fear. We trade on data. Survive the Thursday. Disclaimer, StockSense is an educational platform. I am an analyst, not a financial advisor. The market is in extreme volatility. Trade at your own risk.